business ownership can have its own little subset of complications in the divorce process. It does not mean it has to be tumultuous. It does not mean it has to be combative, but it does mean that the more we can work together towards a final resolution, the better. The first point we want to consider is who owns the business and why is it owned the way it is owned? But more importantly, who operates the business and why is it operated the way it's operated? Some people choose to have the business titled in the name of one spouse because maybe they can get better contracts, maybe they can outbid because they have some diversity criteria that allows them to meet, whereas the other party is actually the person who's operating the business. So we do need to consider ownership versus operation. We then look towards valuing the business. It is always my recommendation that we retain a forensic accountant to assist in that valuation. Forensic accounting is very different than your tax accountant giving you a value of your business. They are not the same criteria. There's some different laws that we consider. There's some different offsets that do not get factored into a matrimonial valuation compared to a third-party sale. So we would want to hire someone to help us come up with the value of your business and also with your cash flow. From there, we then put your business on the balance sheet with the rest of the family's assets. The business would be divided in some proportionate ratio. It is generally not 50-50 because the person who's retaining the business is retaining all of the risk. So they're taking all of the potential future tax issues. They're taking all of the capital gains issues when they ultimately sell it. They're taking the risk of the business going under. So the person who's keeping the business typically has a disproportionate percentage interest in the business. So then the next question becomes, well, how do I get my piece of the business? There's a ton of ways to do this. A very common way is beyond a buyout, obviously, just handing you a lump sum of money. If you're owed a substantial amount that you guys just don't have, you can do a mortgage interest going forward with a monthly payment structure. And when we build that out, we build out a whole separate agreement outside of your marital agreement that includes security interest, interest rates, the taxability of the sale, et cetera. So you're treated as a third-party buyer in some ways, in that you are going to get interest on your deferred payout and you're going to get a deferred payout structure. Retaining a mortgage is not the only way to receive your interest in the business. There's the strictly just buy me out, write me a check, I go away. Then there is the offset and balancing of assets. Plenty of times, the marital home will have a substantial amount of equity, and that equity can be used to offset the business buyout. I always say you want to come to the table knowing what you want. So if you know you want the house, that's a great way to retain the home by using the equity buyout from the business. Think of a balance sheet. It's very simple. This is what I have. This is what I want. Here's what it's worth. Here's what I owe. It's a very simple balance sheet. And that's how you're going to do your ratios on who's going to give whom what. When you're preparing for a divorce or separation as a business owner or as the non-titled spouse or non-operating spouse of a business, it's important to begin to gather documents, whether it's for your attorney or whether it's for the forensic accountant. Everyone's going to need the same information. And here's just a quick kind of hit list or checklist of what you're going to want to get together. You're going to want to get together your taxes. Depending on the type of business you are, without getting too complicated, you're going to want to have your personal taxes and your business taxes. If you do not have access to those, talk to your tax advisor. You're entitled to copies of that information, so go get it. You're going to want to obtain as many bank account statements as you can for the business as well as personal. This should include all investment accounts, all liability accounts. You don't have to worry about gathering a certain time frame, or I can't go to my lawyer until I have 6 months of this information. That's not true. What you want is you want to have a picture of all of the assets, personal and business. And why do I say that if I'm talking to you as a business owner? Because sometimes the business pays for your personal expenses. So by knowing that we have a Lexus loan, but it's for the company car, well, the Lexus loan could be in a personal name, even though it's used for the company car. So we need to know that so that when we go to the forensic accountant, we can figure out, is it actually something that is expensed through the business to reduce the value, or is it a perk that increases the personal income? By you having a single sheet of paper, which tells us the name of the company, bank, credit card, etc., and hopefully an account number, we can gather the rest of the information we need to help you to begin to value not only the business, but also the cash flow that's derived from the business. Divorce does not come as a surprise, nor does separation. Typically, we see in hindsight sometimes where the bubbling started to happen. If you are fortunate enough to see when these issues are arising in your family and before it becomes too adversarial, it's a great time to have a conversation about how do we want to operate going forward. This is particularly true when you have a titled owner who is not the operating member. So by way of very simple example, if you own a type of building construction company, you may have that company in the name of the female household member. And you would do that because you would get some contract benefits when making bids. But the female member may not be the one who's actually out on the job sites. And that might be the male member who's not named in the business. If you find that you're having some issues at home and that this is a route you may see yourselves going, it's a great time to come up with an operating agreement. You can use your accountant to help you create it. You can use a lawyer to help you create it, because in an operating agreement, you want to designate how and who you're going to run this business moving forward. That operating agreement is not an allocation from a marital side. So you're not waiving a claim, you're not divesting the other spouse of ownership. All you're doing is defining how we're going to operate this business, because let's face it, for 90% of the people, that business is the household income. So if you lose the business, say goodbye to your household lifestyle, because you can't have one without the other. So it is always best to work together to secure the family's assets and income, because it really helps both parties. Owning a business in the divorce process can be easy or it can be difficult. It is a decision that two parties have to make. From the legal side, it is an asset that gets included in your total equitable distribution, and the buyout comes through some form of offset on the balance sheet. What makes this complicated is when parties, one, both, either, doesn't matter, make a decision that they're going to hold back or not treat each other in reality when it comes to how this business operates. So the best advice I can give you, and the most cost-saving advice I can give you, is to work together, because this could be the single most expensive piece of your divorce if you decide to polarize. If you have any questions, give us a call, Jersey Coast Family Law.